this is a big, big problem that we have. Once the recession hits, and there will be another recession, the yield curve, by the way, just normalized in December. That's not too long ago. And it usually takes around 3 to 6 months after the yield curve normalizes before you see a recession. And we had the longest inversion of the yield curve in history, and it was the second deepest inversion in history. The spread between the 2 and 10-year note. So I don't throw out my theory that we're in for a lot of trouble. I'm just warning people.
This is the biggest bubble in U.S. history. So when it breaks, expect the depth to be serious, but the recovery to be protracted. What has benefited in each of those time periods? Gold.
So what gold does, as you and I both know, is it's very good at smelling out or teasing out future monetary debasement. So even though right now the central banks don't have the money printer on full speed, gold knows that they're going to have to turn it on. And that's why gold is trading the way it's trading. And so my projection 3 to 5 years out on gold is gold will be somewhere between 3,000 and 7,000, as opposed to today's 2,500. And of course, and I think the world will come to see that. I think there's going to be kind of an aha moment where everyone's going, oh, this is different.
It matters not who becomes the president. It matters not who has power in Congress after this election. The math is the math, and this is not reversible. The government is going to default because they cannot pay that money back in current terms. What they could do is they could print $35 trillion and put it in the money supply. But what will that do? That will absolutely destroy the dollar. So they're not going to default in the form of a non-payment, but they're going to default because the dollar is going to collapse in purchasing power.
We're clearly in a big gold bull market that I think is going to, I'm very excited about where we are right now. But you can just see it coming. I mean, the monetary debasement is coming quick, in my view.
Yeah. Larry, I have a question for you, and maybe you can help me answer it. Back in March 2022, when the Fed started raising rates, sentiment completely disappeared in the junior mining space.
Oh, yeah.
September 18th, the Fed cut rates, and all of a sudden, there's euphoria back in this space. So what I'm trying to understand is the correlation between the Fed and the Fed funds rate, obviously, and the junior miners. Like, I'm really trying to understand that, because the miners did not react at all to 2,700 gold, like maybe a few percentage points here and there, but not as much. Especially sentiment amongst the executive, the C-suite, has changed tremendously. Can you maybe you have an explanation for me?
Well, no, it's just people tend to be backward looking in their looking at investment situations, and the markets tend to be forward discounting, and so it's going to take a little bit more time for that sentiment to change and people to realize where we're going. I mean, I've said this before in other podcasts. I mean, the reason the gold shares are valued where they are is what I described earlier, that the average 5-year out projection is gold at 2050. And as you and I both know, the all-in sustaining cost of mining an ounce of gold kind of marches up pretty consistently at somewhere between 8 and 10% a year, kind of the underlying rate of inflation. And so, people can look at that and they say, well, all right, this company's got an ASIC of 1,400, the gold price is 2070, I'm making X amount or whatever it might be. Now we're up to 2,500 gold price, which means you're making a very much larger margin. But if you're coming back to 2070 over the next 5 years, and in turn the 1,400 gets compounded up at, say, 8% a year, well, your margin is going to disappear. So, the gold mining business is a spread business, the difference between the cost of mining it and the price you sell the gold for. So you need the price that you sell the gold for to go up at greater than the rate of mining cost inflation. And I think that's going to happen. I mean, it has happened. Companies are earning record profits right now, record profits. But again, I think, what do they say? A bull market climbs a wall of worry, and we're in a gold bull market, but everybody's looking over their shoulder. They're worried. I mean, look, we'll know that when we're about to hit a bear market, everyone and their brother will be talking about how it's easy to make money in gold stocks. I remember it. I remember 29, 10, and 11. That's how it felt. And that day's coming again, but we're not there today. We're still. I mean, a lot of people still have the scars from 2011 to 2015 where they lost a lot of money. And since that time, we've slowly been crawling out of the hole. And 2019 and 2020 were pretty good. They were good for my fund. But, then things, Powell started raising rates, everything calmed down, and, we gave back 40 plus % of that gain, over the last 3 years, because ostensibly they've got inflation under control. I mean, the bull case for the other side is that inflation is under control. We're going to go back into a deflationary world. And why would you ever need gold? And, if you believe that, and, that's the correct bet to make. I just don't believe that. I don't believe that set of conditions continues. I think that we're not in a deflationary world. I think we've entered a period of inflation. The 40-year deflationary trend from the 80s to 2020 has now broken decisively. You see it in the labor contracts. You see it everywhere. And that's the other thing. I mean, they say they've got inflation back down to 3%, but we all know they cook the numbers. So personally and otherwise, I mean, I'm sure everyone listening to this has experienced the fact that inflation is a whole lot higher than 3%. I had my house insurance got doubled last year. So my auto insurance went up 30%. That's not 3%. So the fact is, that all has to become more widely known. And as you and I actually were talking about, I think prior to the call, prior to starting this, we compete with the stock market. And, the stock market's been doing pretty damn well. And so, your average investor has got the Mag 7, they've got the triple Qs, they're in the stocks, they've made a lot of money. Some of them don't want to pay the capital gains tax, so they'll at least wait until early next year to sell. But even, most people in general I talk to who are in the stock market are like, why would I ever sell this? I've always been rewarded. In fact, I'll buy more. I've always been rewarded for buying the dip. And that's what I'll do this time too. So, yeah.
I was chatting with Bill Fleckenstein, and that episode came out past Sunday, and we both sort of agreed we need to scare the 401k money into moving into other asset classes.
I think that's right. I mean, we've seen it in the past, and we know that it happens. So once the stock market starts to not perform well, and once the next leg of inflation gets going, and QE and ZIRP come back, our stuff's going to explode. I mean, my portfolio is going to go up 100%, and a lot of investors who are holding those Mag 7 are going to say, "Hey, hang on a second. These things are working over here. Our stuff's not working anymore." And so, because investors, they do chase performance. I mean, they really do. So.
No, 100%, and that's why we're doing this, and that's why I'm in our space, to be quite honest. But I'm trying to understand what is happening, right? And why are certain moves happening? And maybe we'll have to talk about the Fed real quick, because I do want to talk with you about Bitcoin, because you're a Bitcoin expert, obviously, and I have no clue about Bitcoin personally. But we'll talk about the competition between gold and Bitcoin in a second, and if there is really any. But on the topic of the Fed, I touched on it earlier, but we've seen Fed cuts in September and October. I'll make stuff up. September, we've seen a 50 basis point cut. November, we've seen 25, and now we've got one more meeting to come where the market doesn't expect to cut at all. And then the next meeting is about a week after Trump moves into the White House. Give me a bit of sense of like what is the Fed doing? What is the Fed waiting for? All of a sudden, they're data dependent again, despite making announcements of 2 cuts, and now it's just data dependent again. What are your thoughts there, Larry?
Yeah, that's it's a great question. I was just with Danielle DiMartino Booth down in New Orleans, and she said that she thinks the employment numbers are about to come in extremely soft, and that therefore the Fed staffers, their hair is going to be on fire, that we're going into a recession. And she thinks there's absolutely no doubt they're going to cut in December. But if I looked at CME FedWatch, which I just consulted, it's got it kind of at a 50-50. It's a 52% cut, 47% don't cut. If you looked at it objectively, Kai, kind of using all the measures, and the stock market's at record highs, employment's hanging in there, inflation hasn't really gotten to their 2% target. It's still kind of in the high 2s, low 3s. They should pass on this meeting, or arguably even they should raise rates. But guess what? I don't think they will. I think they're cutting, and the reason he did 50 bips on that one meeting is they know they're funding a lot of their debt short term, and so they know they need to get those short-term rates down to prevent the U.S. federal government interest expense from being too large, because that drives the deficits, which it's a doom loop, right? More higher cost, bigger deficit, sell more debt, same size market, interest rates go up, bigger deficit, blah blah blah, rinse, wash, repeat. So the Fed's kind of trapped, in my opinion, and they probably will cut, and after that, I don't know what they'll do. I mean, because I think inflation is going to start to come back. They'll probably continue cutting. I don't know. There's a conspiracy side of me that says, well, maybe what they'll do is they'll actually get tough and try to, prevent inflation, try to raise rates again, knowing that when they do that, the stock market bubble will burst, and knowing that a true bursting of the stock market bubble will give them the cover they need to go back to QE and ZIRP and ultimately yield curve control. Because my view is that they are trapped, and they're, on one side is massive deflation, and on the other side is massive inflation. And they've managed to walk down this thin line for a while now, but they're going to get shoved off the line pretty soon. And when that happens, we know from history that, financial collapse versus print for inflation, they'll pick print for inflation every time. Yeah. We've seen that over and over again. So, and of course, when all of that happens, our stuff goes bananas. I mean, gold goes to $5,000, gold stocks go up 10x, etc. Bitcoin goes up. All alternatives will go up a lot, and they'll be doing all that to quote unquote try and save the stock market. But just like in 2008, and just like in 2000, where when each of those bubbles peaked, they cut rates enormously and quickly. Took them all the way down to zero. Didn't help. The bursting bubble, created a lot of unemployment, bigger deficits. It really became quite problematic. So it's kind of hard for the Fed after the fact to solve the problem.
We're jumping around a little bit, Larry, but I have a follow-up question on that. Sure. I'm just looking at the 10-year yield, and how much is Powell potentially being pressured by the bond market
Oh, there's
to
no
keep
doubt he
rates
is.
high or even move it higher, right?
Yeah, there's absolutely no doubt that he is. I mean, look, he cut rates and the bond goes up and the yield on the 10-year goes. I mean, they don't like that. That's not good. That's not good at all. The flip of that, though, I mean, if they can get the stock market to break and unemployment to go up, there's a pretty decent argument. I was with a smart macro guy earlier this morning talking about it. He said there's a decent argument they'll actually get that there'll be a bid to safety yield in the bond, and the 10-year rate might come down a bit. I suppose that's possible. I don't know. I think that when the stock market breaks and the big print gets announced, the 10-year yield is going much, much higher. Trying to buy bonds right now for a trade because you think the economy is going to slow down or the stock market is going to roll over. That might work, but you're kind of picking up nickels in front of a steamroller.
Now, what we're seeing today, Larry, in the market seems like a Besant trade or the Besant move a little bit.
Yeah,
10 years come down a little bit. The yield meanings like it's 4.3 or 4.29.
Yeah,
S&P broke through 6,000.
Yep. Yeah, the stock market's up and our shit's getting hammered. So it's just another crazy day. Bitcoin
fun times. Fun times, absolutely. Are you at all worried about a liquidity crisis in the bond market next year? Because we need to refinance a ton of outstanding T-bills.
Absolutely. So that's my thesis. My operating model is that at some time in the next year, something breaks and that they cannot get the bonds sold because everybody knows they've lost control of the inflation picture. And so when that occurs, rates will start going higher quickly. And they will need to revert to the same old playbook, which will be, stop the QT, which is, they took QT from 60 down to 25. So they'll turn that off and they'll immediately take interest rates down and they'll immediately start QE, just like they have in the past, whenever, and they'll claim, hey, it was a liquidity crisis. We had to do it. We recognize there's inflation risk, but the fact of the matter is, if we don't do this, the ATMs aren't going to work. I mean, that's always the excuse, right? And so they'll use that excuse to allow them to print a ton more money, and then those of us who have money, the value of it will all get debased, relative to where it was, right?
Buy gold or Bitcoin. For that matter. And let's talk about that. Like,
sure.
Maybe that was the smart segue here to throw going into the conversation, Larry. I'm trying to understand the move. Obviously, a lot of euphoria. The U.S. talking about a Bitcoin reserve, meaning a Fort Knox for Bitcoin. I'm not sure what that's going to look like and who's going to run around with a USB stick in their pocket. But I'm way too pragmatic for that kind of stuff. But give us a bit of an update on Bitcoin. We rarely talk about Bitcoin on this channel. Maybe we'll start from give us the cliff notes on why has Bitcoin moved so much. What's the background here?
Yeah, let me give you the first principles. So, gold is sound money. It's been sound money for 5,000 years and is much more widely distributed and, can't be counterfeited or not easily counterfeited. And so, and you can possess it and so forth, so on and so forth. And so, it's what I call analog sound money. Bitcoin, quickly speaking, is digital sound money. It's what happened with Bitcoin is they invented the concept of digital scarcity. If you think about things which are digital, like CDs and music and movies and phone call, anything digital, a file with a typewritten file, anything digital can be copied a million times. So there's no scarcity in digital land. It's very easy to hit a button and print. I mean, digital dollars, right? Fiat. I mean, they just hit a button and they got more fiat. What Bitcoin did was they solved the problem of creating something where they created digital scarcity. And so they've got an algorithm and a system. It's distributed 20,000 nodes around the world, a bunch of miners who process the transactions where there's legitimate digital scarcity. There will only be 21 million Bitcoins ever. That's the system, and it's hard-coded. And changing it's almost virtually impossible now at this stage in its life. So what you've got is a digital form of something that'll be scarce, which is called one Bitcoin, and I liken it to digital gold. It's and obviously the value of place to it is all a function of the marketplace. But the marketplace, as Menger said, money is the most liquid thing. The marketplace looks at what's money and looks at the characteristics of any sort of money or asset, and then places a value on it. Right now, the value of Bitcoin's in the $90,000 range. It started off much lower. And money, in my view, has always been a ledger. Before gold even existed, people kept score by putting marks on the walls of caves. So, money is just a social obligation that says, I owe you this or you owe me that. And so it doesn't necessarily have to be a physical thing like gold, as Peter Schiff contends. But it can be. And so that's kind of the brief summary. And a lot of people have gotten thrown off the track because of all the other cryptos. They're all total bullshit, and there's a lot of fraud and Sam Bankman-Fried and everything else. But Bitcoin's actually a technological innovation that people should study. So starting from that as a first principle, Bitcoin's got one advantage over gold, and that is gold is widely distributed. It's been around 5,000 years. It doesn't go up very rapidly because everyone who wants to own it already owns it or has known about it for a long time. Bitcoin's one of those things where almost nobody knew about it 10 years ago, and more people know about it now, but still the percentage of people who own it is quite small. And so if it's growing into a form of money, and I believe it is, and more people are coming to see that the properties that it has are valuable, and I think that's occurring. You can see the evidence of that. Then you've got more people competing for the same number of coins outstanding. So there are 46 million millionaires in the world. There are 21 million Bitcoin. So every millionaire cannot own one Bitcoin. And yet you can buy a Bitcoin for 97,000 right now. So what I would contend is that Bitcoin is going to continue to become more valuable. Now, the price you pay for that asymmetric upside